Hi, I'm Roy Robertson. Welcome to Good Business San Diego, where we talk to local business leaders about the positive impact they make in our community. And the following portion of Good Business San Diego is sponsored by Wilsey Asset Management. So many of us are invested in the S&P 500. That's the index that gives us some diversification in our portfolio. But does it also expose investors to hidden risks? Brent Wilsey, the president of Wilsey Asset Management, is here with the answer.
Thank you, Roy. And again, some diversification is probably the right way to say it because it's not the way it used to be. I mean, I'll talk a little bit more about that. But the S&P 500, there's unknown risks I want to kind of explain to people so they understand how they're investing. And first of all, people feel very comfortable with it because over the last 5 years, they received 106% gain on their money. Going back 10 years, well, gosh, the gain then was about 224%. But they forget about things like the 10-year period ending in 2009, where actually that 10-year period, the return was on an annualized basis a negative 1% per year. They call it the lost decade, where people made no money in stocks in the S&P 500. Sorry about that. The problem with it is the overconcentration of companies that they have. Right now, 10 companies account for 38% of the index, which is way high. Think about that. That means the other 62% is accounted for with 490 companies. And that's a problem because those 10 companies are tech companies. 8 out of 10 are tech companies. That's not a good thing to have because they're very pricey. And then you also want to look at the valuations. We've talked about this as well. Over the last history of the market, the average PE ratio is about 14 to 17. The S&P 500 right now, it's at 25.3 times. That's very expensive. It means it would take you 25 years to earn back what you paid for that stock based on the earnings. Too expensive. The other thing that came out, I realized this past week, was something called non-GAAP earnings. And 71%, or about 350 companies, use non-GAAP earnings. And that's a problem because you're not comparing apples to apples. And about 89% of those adjustments that these companies use, well, it gave them better earnings, so it made them, their stock, their company look far better than it really is. Now, what is non-GAAP? And GAAP, by the way, stands for Generally Accepted Accounting Principles. Non-GAAP was originally designed to kind of help out companies if they had a fire in their factory or something, or maybe they had, the sale of a division or something of that nature that was really extraordinary. Okay, non-GAAP. But it's being abused now today by, again, about 350 companies at S&P 500 by using it for such things as stock-based compensation. We'll take that out. Well, it is compensation, I always say, so it should be taken out. They also take out such things as amortization of intangible assets. They also take out currency fluctuation, which happens all the time, and restructuring charges. They restructure. This happens many times, year after year after year. So the non-GAAP has almost become the norm, which makes it very difficult for investors to compare a non-GAAP company to a GAAP company. So I'm not sure what the SEC is here. I would like to have the SEC come in and kind of talk about, hey, let's crack down on this, because for investors, it's very difficult trying to do good investments. And then when the decline happens, why that happened? Well, things were overexpensive. Things were not done properly. And this is why I say the S&P 500, you may feel very comfortable with it, but check into it because it's very risky, and I don't think it's going to do very well over the next 10 years. A lot of this information does come from our newsletter. It's smartinvesting2000.com. Again, that's smartinvesting2000.com. That goes out every Friday at 5 o'clock. On that newsletter, we also had watch out for the Chinese stock scam. Also, too, is a current 401k system. Is it out of date? And consumers are confused on what the tariffs are costing them. smartinvesting2000.com.
Brent, thanks so much. The preceding portion of Good Business San Diego is sponsored by Wilsey Asset Management, and we will be right back.